Alright guys, well yesterday was fun, huh? The stock market had its worst day since September of 2020, and crypto market apparently was down about 9% as well. But that's really kind of normal for crypto, am I right? Anyway, today we've got the Ethereum merge, and according to this on Google, it says it's happening in 8 hours and 25 minutes at the time of recording, so by the time you see this, it may have already even happened. If this does go well, then it's probably going to go up, I would think, and Ethereum might have a little bit of a relief. But if it goes bad, then it's going to probably go down. But you could probably already figure that out, right? Here we have the Ethereum chart looking at the 4 hour, and you can see that we did have this rising wedge, which is a bearish signal, and usually the price target for those is the bottom of the wedge. So it could definitely be continuing down into this and go down to about $1,000 again. But as you can see, it does also have a possible cup and handle formation, it looks like right here, and that's just me being speculative and hopeful. And if this plays out, then the price target for that is usually you take the height of the cup right here and take it from the breakout point on the handle, and that would take us up to about $2,000. So hopefully that is what's going to happen, but it just really basically depends on how well the merge actually plays out. Looking at the 4 hour chart, the MACD does look like it's starting to have a convergence to the upside, and that means that it could be having a little bit of a relief, and hopefully this cup and handle will play out here. But as you can hopefully see here on the daily chart, it is pretty much doing the opposite. So we've got mixed signals here, and like I said, it just depends on how the merge goes. But really, that's just what matters in the short term. But I think we really have to look forward to what's going to happen in a week from now on the Fed meeting. Yesterday, we did have this big dump right here, and that was indicated by this huge red dildo. But looking at the economic calendar, you can see that we did, unfortunately, have a little bit higher than expected CPI readings coming in yesterday, with an expected negative 0.1% and an actual 0.1%. So that means we got 0.2% higher than expected, and that was a negative sign for the markets, because if we continue to see inflation going higher, then that means the Fed is probably going to have to continue raising interest rates. Looking here at the release from the Bureau of Labor Statistics, you can see that all items less food and energy, which is core inflation, went up by 0.6%, and that's usually what the Fed has been looking at recently, and that going up from last month is not a very good sign. That means that they might actually do, and some people are even speculating up to a whole percentage point or 100 basis point hike, and that would definitely be negative for the market. But it looks like up until this point, we do have 75 basis points already priced into the market, and if we see 75 basis points, maybe we go sideways, but anything less than that, I think we're going to have a little bit of a relief rebound here. It does look like inflation has started to cool off, and I think that might be just because mostly we had higher readings earlier and they're just being compared to that. So it's just going to look a lot lower now, and that is bullish for what the Fed is going to be doing in the future. We need to see this coming down, and the Fed said they want to get inflation back down to 2%. So that means that we're definitely going to have to continue seeing these month-over-month readings declining over time. Until then, I think we're not going to see the Fed pivot, because we are probably going to see them at least holding rates as high as they are, and a pivot means that they're actually going to start lowering rates again. In the meantime, hopefully, since inflation does look like it's starting to take a little bit of a pause, maybe the Fed won't continue to raise the percentage points of interest rate hikes that they're doing, meaning that maybe they won't actually move to do a whole 100 basis point or 1% rate hike. That would be probably really bullish for the market if we don't continue to see any more surprises, because the market usually only goes down because of uncertainty, and whenever we do start to see more certainty from the Fed about what they're going to do and what the interest rate hikes are going to be looking like from this point forward, then I think we can at least start to level off, and hopefully then we can be even starting to look at a recovery. But if the Fed does continue to do increasingly higher rate hikes, then I think it's going to continue to look really bearish, and we're just going to have to wait to see what they say 1 week from now on Wednesday. I have talked in the past about how we've been in this long-term downtrend over the past couple of decades, since at least the mid-80s, for the Fed funds rate, and it looks like we are starting to break above that downtrend. A lot of people are saying that this is a really big shift in the way that the Fed is going to be operating from this point forward, and that means that they could continue to raise interest rates for the foreseeable future. But even if you look back here in the 50s, whenever we did start to raise those interest rates again from almost a 0 point, you can see that they did raise it up to about 3.5% before they had to drop it again because of a recession. It didn't just go up in a straight line all the way up until about 20% where it was in the 80s. It did go up, and then it had to have a couple of more dips as they lowered the interest rates due to recessions. I know that the people in charge are trying to say that we're not in a recession still, but whenever we get this third quarter of negative GDP, I don't think they're going to have an argument for that anymore, because we've definitely already been in a recession since the beginning of the year. If the Fed does lower interest rates before we start to see these month-over-month readings of inflation coming down significantly, and it looks like we're headed back towards 2%, then we are probably going to have higher entrenched inflation, and it's going to be a problem for the next decade or so. And you might be thinking that it's obvious that that's not what the Fed wants, and so they're going to have to continue to raise interest rates, but there is a really big problem that it is crushing the economy. And I'm not just talking about our economy. If you think our economy looks bad, just go and look at Europe. Those guys are having a really rough time. This article by Markets Insider says that BlackRock recently announced that Europe is going to spiral into a severe recession as the energy crisis hikes inflation and weighs on GDP. All of this is really going to continue to be an issue as the dollar continues to climb, because commodities like oil and also a lot of energy is priced in dollars. So as they continue to have a hard time getting their hands on energy, they're going to continue to have more of a crisis as their economy slows down and they can't continue to accumulate enough dollars to buy that energy. This is the federalreserve.gov website, and as you can see, all of these blue bars are the US dollar's share of foreign currency debt issuance. And this shows that almost all of the debt around the world is US denominated debt. And whenever the US dollar goes up in value, it makes it really a lot harder for other countries to pay back these debts. They're making money in their own currency, but they're trying to pay back the debt in US dollars, and that's really hard whenever the US dollar is rising against all other currencies. This is what they call the dollar wrecking ball, and as you can see, looking at the graph for the dollar, it has been ripping really high recently, but I'm going to get to this chart here in a moment, and it looks like it might be topping out, hopefully. The more the Fed continues to raise rates, the more the dollar is going to continue to climb, and the more it's going to be difficult for all of these countries to also buy stuff like commodities and oil, because all of that stuff is also mostly priced in dollars. According to this, in 2019, more than 80% of all global exports were denominated in dollars. And that means that dollars are used for almost all of global trade, and it's really important for there to be liquidity in the system. If there's not liquidity, then these economies are going to be totally crushed. And the question is if the Fed is going to be able to totally crush the global economy, or if they're going to have to actually continue printing and cause a further inflation crisis here in America. With inflation starting to level off, maybe they are going to start to talk a little bit more dovish, and maybe we can see them start to slow down their interest rate hikes, but not actually start to pivot. That could give the global economy a little bit of time to catch up to what the Fed has already done so far, and that could hopefully give time for the numbers for inflation to continue to the downside, and then they won't make this recession harder than it has to be. But as we know, the Fed usually overdoes whatever they are doing, and with them tightening right now, they just might continue tightening into this recession and destroy everything. If the Fed does announce that they're not going to be continually doing higher and higher interest rates, then I think a lot of the fear will leave the market, and maybe the dollar can actually start to come down a little bit, putting some pressure off of the global economy. Looking at the weekly chart for the DXY, there is a bearish divergence here on the RSI, and it looks like the MACD is starting to converge on itself and possibly even cross over. And if these bearish indicators do start to play out and the DXY heads lower, then that means commodities like gold and Bitcoin and cryptocurrency in general can probably start to head to the upside. A lot of the stock market still might be in for a dip because of earnings going down, and that means that things like Bitcoin, gold, and commodities and other things that don't have earnings could be spared from the second leg of the recession. What we need to see is liquidity start coming back into the system because of the Fed slowing down their rate hikes, and then as the stock market continues to the downside because of decreased earnings, people might start to look for other places to invest money where they're not losing it, and then that search could lead them into putting money into Bitcoin. Usually after the low point of the bear market, Bitcoin will run first, and whenever people start putting money back into Bitcoin, I think that's going to be a good sign that the rest of the crypto market is going to follow pretty shortly. I said in my last video that I didn't think we were going to make a lower low, and while we did have about a 10% dip yesterday, this wasn't a lower low, and I still do think that we're not going to be making a lower low below about $17,000. Bitcoin did make a higher low right here at the bottom of this wedge, and as I said before, this is a downward wedge, and the price target for that is the top of the wedge. So while I know that we did get a rejection as we pumped up above this downward trending resistance line that we've been under for the past few months, it looks like for now at least we do have support here at this orange line, which is the previous all-time high from 2017. And as long as we don't break down below that and the Fed doesn't do a shocking whole percentage point hike on next Wednesday, then I think that hopefully this is going to be the indication that we're looking for, and that we're not going to make a lower low, like I said, which will bring us back up above this downward trend again. And hopefully, while we might not be going straight up to the moon, we could go sideways and form a floor and get ready for the next bull market, which could, like I said in my last video, be up to another couple years. But I don't think really that matters. What really matters is that you want to try to make sure that you're not going to go lower. And at the bottom of the bear market, there is usually a good solid floor that lasts a little while. And you want to take as much advantage of that and accumulate for as much time as you can. So that's why we're looking for the bottom and not for the beginning of the next bull market. I guess that was a little long-winded, more than I thought it would be, and maybe it might have been a little bit complicated, but I hope you guys could really understand what I was saying, because if the dollar does continue to go up, it is going to be a wrecking ball and continue to destroy the rest of the global economy. The Fed has to decide between maybe having a little bit higher than normal inflation going forward from here, or just totally destroying the global economy. Let me know what you guys think is going to happen in the comments, and thank you guys so much for watching. I hope you have a wonderful day, and thanks for hitting that like button. I'll see you guys next time. Bye.